Mark September 9th on your calendar. That's the date the U.S. Treasury Department has confirmed it will double the size of its long-term bond buyback operations. A real, scheduled policy change. Not a rumor, not a leak. And it lands right in the middle of a stretch that already includes a Fed symposium this week and the final run-up to the midterm elections. I want to walk you through exactly what's scheduled to happen, why the Treasury announced it now, and what the honest range of outcomes looks like, without the hype and without pretending anyone can tell you exactly how markets react 3 weeks from now. And there's a detail buried in the Treasury's own announcement about which part of the bond market this specifically targets that tells you a lot about how worried they actually are. I'll get to that in a few minutes. Quick note before we go further. This video is for informational and educational purposes only. I'm not a financial advisor, and this isn't personalized investment advice. Government policy and bond market mechanics are genuinely complex, and outcomes are never guaranteed. Everything here is accurate as of when this was recorded. Please do your own research and talk to a licensed advisor before making decisions with your money. Now let's get into it. Section 1. What's actually scheduled for September 9th. Let's start with the confirmed facts, because this is a real documented policy change, not speculation. On Wednesday, August 19th, the Treasury Department announced it will at least double the maximum size of its long-term bond buyback operations from $2 billion per operation up to at least $4 billion. This applies specifically to the 10 to 20-year and 20 to 30-year portions of the Treasury market, the longest dated government debt. The change takes effect September 9th and stays in place through November 4th, when Treasury conducts its next scheduled review of its borrowing plans. Here's the detail worth sitting with. That expansion window runs right through the final stretch of the midterm election campaign. Treasury has framed this purely as a debt management tool rather than anything politically motivated. And to be fair, buybacks like this are a standard, long-standing mechanism, not something invented for this moment. But the timing is a fact worth knowing, regardless of how anyone interprets it. The announcement didn't happen in a vacuum. It came the same week the 30-year Treasury yield climbed back to its highest level since 2007, and just before a $16 billion auction of new 20-year bonds. According to Bloomberg's reporting, the announcement caught markets somewhat off guard, since Treasury had only published its regular quarterly buyback schedule 2 weeks earlier, meaning this wasn't the routine update, it was an unscheduled acceleration. Before we move further into today's topic, I want to recommend something I genuinely believe can be valuable, especially if you're serious about understanding precious metals. The book is called The Precious Metals Trap. It goes beyond gold and silver prices, helping you understand the psychology, risks, common mistakes, and hidden traps that can affect precious metals investors. And because so many of you asked for it, the price has now been reduced by 50% for the next 3 days only. If you're serious about improving your understanding of gold and silver, I'd strongly recommend checking it out while the offer is available. The link is in both the description and the pinned comment. Now let's get back to today's topic. Section 2. Why the Treasury made this move. A buyback like this exists to solve a specific problem. Not enough buyers showing up for the longest dated part of the bond market on their own. Treasury itself said the expansion targets sectors where there is consistent, strong sponsorship from market participants. In plainer terms, where investor demand had been inconsistent enough that the government wanted a larger, guaranteed buyer standing behind that part of the curve. Other reporting described the 10 to 30-year sector as having faced what amounted to a buyer's strike since late June. When asked directly by a reporter whether Americans should be worried about the bond market, President Trump responded, "No, I don't think so." That's a real, on-the-record quote from the same week as the announcement, worth including plainly, without reading more into it than what was actually said. The market's initial reaction was immediate. The 10-year Treasury yield fell roughly 5.7 basis points to 4.647%, and the 30-year yield dropped about 9 basis points to 5.196%, while stock futures rose. Gold and silver moved higher in the same window, gold climbing past $4,600 for the first time since mid-May, and silver clearing $70 for the first time in about 2 months. Now here's the part of this story that explains why a bond market mechanic moves the price of a metal that has nothing to do with government debt on paper. Section 3. Why this connects to gold and silver. Here's the mechanism in plain terms. Gold and silver pay no yield, no interest, no dividend. When Treasury yields are high, holding a non-yielding asset instead of a bond carries a real opportunity cost. When the Treasury steps in and buys back its own long-term bonds, it pushes those yields down. And a government visibly managing its own borrowing costs this directly also tends to put downward pressure on the currency itself. Lower yields plus a softer dollar shrink that opportunity cost and make gold and silver relatively more attractive, which is exactly the pattern that played out in the days following the August 19th announcement. And it's the same mechanism that would be expected to repeat, at least in the short term, around the September 9th expansion date. It's worth being precise about what this is and isn't. This is one policy lever among several, not a singular event that determines where metals go for the rest of the year. But it is a real scheduled date with a documented mechanism behind it, which is more than can be said for most of the watch this date content floating around this space. Section 4. The honest risk, both ways. I want to be direct about how uncertain the next few weeks actually are. If the September 9th expansion proceeds as scheduled and Treasury continues framing it as ongoing debt management rather than a one-time event, that's the kind of sustained pressure on yields and the dollar that's historically supported continued strength in gold and silver, not just a one-week reaction. On the other hand, if incoming inflation data forces a more hawkish tone from the Federal Reserve, or if this week's Jackson Hole Symposium produces commentary that pushes back against the market's current expectations, the same yields and dollar mechanism can reverse quickly. Both gold and silver have already shown this year they're capable of giving back a substantial move in a short window. Silver's nearly 50% correction from its January high is proof of exactly that. Both paths are genuinely live. Nobody, including me, can tell you with confidence which way this breaks, which is exactly why the responsible thing to do is explain the mechanism clearly rather than promise you an outcome. Section 5. What to actually watch. Keep it concrete. First, whether the September 9th expansion proceeds as announced and whether Treasury signals anything about extending it further at the November 4th review. Second, the tone coming out of this week's Jackson Hole Symposium, since that lands before the buyback date and could shift the backdrop it arrives into. Third, whether foreign demand for U.S. Treasuries, a trend that's been softening over the past couple of years, shows any sign of stabilizing, since that's the underlying pressure the buyback program exists to offset. And fourth, how the 30-year yield behaves in the days around September 9th itself, since that's the most direct, immediate signal of whether the mechanism is working the way Treasury intends. None of this tells you what happens on any single day, but it tells you what's actually worth paying attention to between now and then instead of just reacting to whatever headline crosses your feed. So here's where that leaves us. September 9th isn't a rumor or a leak. It's a real confirmed date when the Treasury's long-term bond buyback operations double in size, landing in the middle of an already eventful stretch that includes this week's Jackson Hole Symposium and the run-up to the midterms. The mechanism connecting that policy decision to gold and silver prices is real and traceable. Lower yields, a softer dollar, less opportunity cost for holding assets that pay no yield. Whether that translates into a sustained move or a short-lived reaction is genuinely still an open question, and anyone who tells you otherwise with total confidence is selling you certainty the data doesn't support. If this helped you understand what's actually scheduled to happen instead of just reacting to a vague headline, subscribe so you catch what happens as we get closer to the date. And let me know below, were you already tracking September 9th, or is this the first you're hearing of it? This isn't financial advice. Do your own research, and I'll see you in the next one.